the interesting thing is that, everyone is concerned about the stock market. The stock market's really small compared to the larger market. The largest market is the FX market, so the foreign exchange market, and that is really the currency pairs themselves. So, the dollar versus the euro, or the dollar yen, or the Swiss franc and where that's at. And to your point, so now that we went away from a gold-backed dollar and it's sort of a floating exchange, well, there has been this implicit backing to the dollar, and that is oil. And really what Kissinger and Zbigniew Brzezinski and a couple others basically sort of brokered some of those deals with Saudi Arabia, who's been our partner for a long time at this point. We have a deal with them that they will only trade oil in dollars globally.
Right.
And so all other countries have to somehow get dollars. Now, if you remember, we can print dollars. They cannot. So they are very much concerned about the stability of their currencies, because that is the stability of their ability to buy oil and energy. And as we all know, oil is what fuels the global economy right now. Now, obviously, that's shifting with technology changes, but by and large, right now, oil is what drives the global economy, whether it's your cars, whether it's factories, whether it's the electricity that's coming through your house, whether it's the farmers themselves, in the food production supply, that cost of energy. So oil, natural gas is really a major factor into that, and natural gas for heating people's homes in the winter. We used to do a lot of coal, we used to do a lot of other energy, but right now it's mostly oil. And so everyone has to keep their currency relatively strong, because they know that they're going to need dollars and to purchase this on the global market. And so that sort of dovetails a little bit into what now I'm starting to actually read and understand about, which is the euro dollar. And that's really more of a wonky term, but essentially it just really means dollars that are not within the United States, but dollars globally that are traded. Because all of these other countries keep dollars in their central banks and keep United States treasuries in their central banks, and then give their citizens the dollar, their local currencies. But at the end of the day, for global trade, they're swapping that out for dollars.
Interesting. So on our side, in the U.S., the process of how a dollar is created and how the Treasury and the Federal Reserve and all these institutions, how they all sort of work together to get that final dollar hot off the printing press.
Yeah. It's so like I said, so it's a debt-based system, right? So, and the interesting thing is that this is all starting to change right before our eyes. With the Fed, really over the past 10 years since the global financial crisis, doing their quantitative easing or quantitative tightening, they do a lot of exchange rate manipulation, essentially, to get that into the to sort of affect the economy. And really what that is the cost of borrowing money. And so when I say it's a debt-based system, all of our dollars theoretically net out to zero. So the dollar liabilities and the dollar assets. So every dollar that's created was created out of debt. Someone took a loan out, or a mortgage of a house, or really what the United States Treasury does is they sell Treasury bonds, and they also the Federal Reserve gets those, and the Federal Reserve sort of they give a check to the Federal Reserve, and the Federal Reserve prints cash and gives it to the government to sort of disseminate out. So there's a lot of different avenues, though, because all banks themselves actually print money. A lot of people think that it's just the Federal Reserve or just the Treasury that's printing money, but really all the banks are printing money too, and they're doing that by creating loans. So for instance, they have reserves, which is your savings in the bank, or some other reserves that they have, like treasuries or corporate bonds. But when you go get a mortgage, they actually freshly create that money as a ledger in their balance sheet. Now, that wasn't there. They don't necessarily, because we're on a fractional reserve lending banking system, that they only have to keep a certain amount of reserves. And I think this might change recently, but really what the crazy thing is for the first $10 million, they have to keep 10% in reserves. And then from $10 million to $50 million, they have to keep 3% in reserves. So for basically the first $50 million of money they create, it's about 2.7% is the reserve in the bank. And that's the Federal Reserve requires banks to do that, to stay solvent, essentially. From that point on, the reserve requirement is, actually, I'll let you guess. Do you know what it is?
I couldn't even begin. It's a
Zero.
small fraction.
0%.
Oh, wow.
0%. So
Okay.
from 50 million to infinite,
Now,
there's no reserve requirement.